My name is Mike Sullivan. I'm a former revenue officer with Internal Revenue Service, and I want to explain the trust fund penalty to you and how it gets asserted against people. I worked at IRS for a number of years, a long time actually. I've worked thousands of IRS cases, and I used to set up the trust fund penalty at IRS. And how this all comes to be is obviously you get an alert that someone hasn't filed tax returns, and tax returns aren't filed, or there's a debt. So you are called in as a revenue officer to go ahead and make an investigation to find out if there's tax returns that need to be filed. Once you know there's an assessment supposed to be there, returns filed, and you know that company's in or out of business, you've got to find out and make demand to pay this liability in full. Many times by the time the revenue officer gets the case, guess what? These cases, these companies are closed, and now you've got to go ahead and find out who's responsible. So you contact your state and got corporate records. You can pull LexisNexis. When you find that, you can find out who the registered agent was. Then you drill down on where the bank account was, and then you pull corporate resolutions, bank signature cards, and canceled checks. With that information, you make a determination who in fact was responsible to pay the tax, who actually had the authority to go ahead and do that. Many times, if you can, you take a 4180 interview. You may want to download that. That is a source that the revenue officer uses kind of exclusively to see who's responsible. You usually want to get it on 1, 2, or 3 people. By the time you start getting bank records and canceled checks and take the 4180s, it doesn't take you long. If you worked a lot of cases, you can drill down who's responsible. Once IRS knows who's responsible, they're going to make a proposed assessment against responsible people. Can be 1, 2. I've had 12 people one time responsible for the trust fund tax. It's all one tax liability, but 12 different people. It's not a visible penalty. It's all or nothing. Everyone's going to get set up for the same liability if they're responsible for the same periods. Your best course of action is to challenge it. If you can get a letter where you can actually file an appeal, I suggest you go ahead and file that appeal to try to go ahead and say in some way you're not responsible. If you're a single member shop here, you're not going to get out of that debt no matter what. But if you think you have a shot and there's reasonable circumstances, by all means go ahead and say, I want my shot at appeals. I want to show I'm not responsible. How do you show you're not responsible? Well, you got to blame someone else, and you got to have documentation to show. IRS isn't going to go after you if they don't have any information on you. We just, as a revenue officer, I never did that. I don't want to waste my time. Your job is to shift the blame on somebody else. I've worked hundreds upon hundreds of these cases. If you need representation from the trust fund penalty, it all starts with the 4180, all starts with the canceled checks, all start what other people say against you, and then the case is put together. It's no one fact, it's a preponderance of evidence. If you need me, I'm really good. I work larger cases. Thank you very much. I worked at IRS for 10 years. I'm a national figure in IRS tax resolution. I've been on the national news many times. I hope this was beneficial. You can always send me a text or email me. Thank you so much. Give me a subscription.